The rise of superstar firms describes the rapid growth of already large companies. One way to see that is to trace over time the combined sales of the 500 firms which in a given year were the largest US companies. These sales in real dollar value tripled from the early 1970s to more recent years. One important contributor to this development is the rise of the so-called big tech firms like Amazon or Apple that will be the subject of some of our upcoming program this afternoon. But the phenomenon is actually more broad-based and also includes companies in other sectors, such as Walmart in retail. Indeed, when we look at more detailed retail industries, such as car dealerships in the United States or pharmacies or home improvement stores, then we see that in the average such industry, the combined market sales share of the 4 largest companies has more than doubled from the early 80s, where it was 14%, to more recent times when it is above 30%. And that development is not unique to retail industries. We also see trends towards more market concentrations in every other major sector, be it finance, be it manufacturing, be it services, and other research has found similar trends in European countries. The question is then, why do we see a rising dominance of big firms? This is still an area of very active research, a question that I think is not yet fully settled, but I would say perhaps one of the leading hypotheses is that the bigger firms were better able to make use of the opportunities brought about by the computer revolution. The chart that you see on this slide shows how large firms in France, the firms to the right on the chart, had greater per worker investments into software technology. And one possible explanation for that pattern is that the large firms, on the one hand, have the financial power to shoulder the large fixed costs that may be needed to implement the new technology platform, and at the same time, the large firms will later benefit from any new technology that lowers the production cost by a certain percentage. A given percentage of cost reduction translates to a much bigger dollar or euro amount of saving in a large firm. Other hypothesis for this rise of superstar firms is the observation that we have falling rates of new startups entering the economy, may be related to some evidence that research productivity seems to be declining. That, of course, means also that the big incumbent firms in an industry tend to get less competition from new players. A third possible hypothesis is that antitrust regulation may either be weak or at least weakly enforced, an argument that has particularly been raised in the context of the United States. This rise of the superstar firm then has important consequences for the aggregate economy. First, we see that the prices that these market-dominant firms are able to charge in their output markets have been increasing relative to the marginal production costs. This means, as a consequence, that these large firms are unusually profitable. And when firms make large profits, then usually this means that capital incomes of the firm's owners are increasing primarily rather than the salaries of the employees. And with these large firms becoming more dominant, we therefore have higher profitability in the economy and a shift of the aggregate income of the economy away from workers and towards capital owners. This has important consequences for income inequality in society because capital income is usually much more concentrated in the population than is labor income. This means only a small segment of the overall population has a meaningful amount of wealth that generates a large capital income, while labor income are more evenly dispersed. And so a shift of aggregate income away from labor towards capital generally leads to greater income inequality. This now presents policymakers arguably with a dilemma when they think on how they should react to the growth of superstar firms and whether they should put restrictions on that development. On the one hand, you could argue that a stricter regulation of these firms would be justified to the extent that we want to prevent such firms from exploiting their market power over consumers. We might want to prevent such firms for blocking smaller competitors from entering into their markets. And we might also perhaps more broadly be concerned with an economic development that contributes to greater income inequality and the many social problems and political divisions that are associated with that greater inequality. On the flip side, it's also important to mention that many of these superstar firms are actually highly productive and innovative companies, firms that have generated new products and services that consumers highly value, and firms that also have been important contributors to economic growth. In that sense, the big challenge for policymakers is how to rein in the negative consequences that these economic developments have, while at the same time not destroying the good contributions that these firms are making to the economy.